Hi, it's Lucas, your host at the Strange World of Econ, and today we'll be taking a look at 3 questions that, according to legendary mutual fund manager Peter Lynch, every potential investor has to ask themselves before they buy a single share in any company. Question number 1. Do you own your own house? Peter believes that most investors are better served in investing in a house first before they consider investing in equity markets. Before you do invest anything in stocks, you ought to consider buying a house, since a house, after all, is the one good investment that almost everyone manages to make. This is because your chance of making a successful and profitable home investment is much higher than in the stock market. Peter points out that millions of real estate amateurs have made money from their home purchases, and it's extremely rare that you will lose all your money on a home investment versus investing in some risky high-tech startup that could go belly up any second and completely wipe out equity investors. Even long-time blue-chip stocks like the once mighty Eastman Kodak and GM can be risky investments. GM, once the titan of industry, declared bankruptcy in 2009 and was only resurrected with assistance of the US government. While housing isn't a guaranteed investment, the odds of you making a profitable investment in housing are pretty good. I'm sure there are exceptions, such as houses built over sinkholes and houses in fancy neighborhoods that took a dive, but in 99 cases out of 100, a house will be a moneymaker. How many times have you heard a friend or an acquaintance lament, "I'm a lousy investor in my house"? I'll bet it's not often. Peter also points out that investment in home ownership is slanted in favor of the owner. Investors are able to make a leveraged investment in their home through home mortgages. A 10 to 20% down payment allows investors to invest in an asset that's worth much more than their initial investment. True, the use of leverage amplifies both gains and losses, but unlike buying stocks on margin, if the price goes down on your home, the bank won't ask for more collateral. Margin stock investments do require additional collateral to maintain leverage positions if the price of the stock goes down. Then there are favorable tax deductions associated with home investments versus equity investments, and typically profits made from selling your primary residence are tax sheltered. I won't get into specific tax implications of home investments because they vary state by state, country to country. Also, many home investors are able to stick with their home investments for the long term because, for one, they aren't constantly presented with a price for their home or bombarded with news about the value of their home. Unlike stocks, which have their prices constantly updated and presented for all to see. A 5% decline in a stock can have investors second-guessing their investments, while home investors usually just have a vague idea what their homes are worth. It's psychologically easier to hold on to a home investment for the long term than an equity investment, as Peter points out. It's not likely you'll get scared out of your house by reading a headline in the Sunday real estate section, "Home prices take a dive." They don't publish the Friday afternoon closing market price of your home address in the classifieds, nor do they run it across a ticker tape at the bottom of your TV, and newscasters do not come on with a list of the 10 most active houses. Houses, like stocks, are most likely to be profitable when they're held for a long period of time. Question 2. Do I need the money? Peter points out that you need to review the family budget before you buy stocks. Stocks in the short term can be quite unpredictable, especially if you're investing in small companies or companies with a highly speculative following. These stocks can swing 4 to 8% daily. So if you need the money in the foreseeable future, say to pay for a child's college education in 2 or 3 years, don't put that money into stocks. As we pointed out earlier, it's not just small companies or speculative stocks that can be risky. Large blue-chip stocks can also be risky in the short term, as GM's bankruptcy points out. Even if you invested in a safe company, its stock price can be dragged down due to macroeconomic events like the 2008 financial crisis, which devastated the return on almost all stocks. It can be extremely hard to predict these macroeconomic events a few years out, even for professionals and academics. Due to the unpredictability of stock performance in the short term, Peter warns, only invest what you could afford to lose without that loss having any effect on your daily life in the foreseeable. Question 3. Do I have the personal qualities it takes to succeed? Investing in individual stocks isn't for everybody. Not many things in this world are. I've accepted the fact that I could never be a surgeon, coroner, or a butcher because I get squeamish at the sight of blood. Many individuals will notice that they don't possess certain qualities that would make them successful investors in individual stocks, and that's okay. Those individuals can invest passively in the market through index funds or through an actively managed mutual fund, or avoid equity investments altogether. Peter Lynch points out that to be a successful investor in stocks, they should possess the following qualities: patience, self-reliance, common sense, a tolerance for pain, open-mindedness, detachment, persistence, humility, flexibility, a willingness to do independent research, an equal willingness to admit mistakes, and the ability to ignore general panic. In terms of IQ, probably the best investors fall somewhere above the bottom 10%, but also below the top 3%. The tolerance for pain is a very important quality that many people don't possess. It's very hard to watch your investments take a nosedive without feeling queasy in the stomach and wanting out. To have enough conviction in your own research into the company and standing by your decisions even when the market is plummeting. As Peter points out, some have fancied themselves long-term investors, but only until the next big drop or tiny gain, and at which point they quickly become short-term investors and sell out for huge losses or the occasional minuscule profit. It's easy to panic in this volatile business. Many investors tend to rely on their gut feelings for when to buy or when to sell, even though they may not possess any special knowledge or reasons why they should be buying or selling. It's the rare investor who doesn't secretly harbor the conviction that he or she has a knack for divining stock prices or gold prices or interest rates, in spite of the fact that most of us have been proven wrong again and again. It's uncanny how often people feel most strongly that stocks are going to go up or the economy is going to improve just when the opposite occurs. And this leads to Peter Lynch's point that a potential investor needs to be willing to perform their own research rather than relying on gut feelings and intuition. Some of us are too lazy, too busy, unequipped, or simply not interested in performing the research necessary to make an informed decision to invest or not invest in a particular company. For many potential investors, reading annual financial reports is probably less enjoyable than reading the latest thriller from Stephen King. You have to be willing to look at yourself in the mirror and ask yourself honestly if you have the qualities to be a successful investor in individual stocks. Thanks for watching. I hope you learned something from legendary investor Peter Lynch. Please like and subscribe to the Strange World of Econ channel. It's a great free way to support the channel so I can bring you more investing advice from legendary investors. Till next time.